Bestie means a lot to me. So thanks, you guys.
Yeah, and we'll continue the discussion perhaps at the All In Summit in May.
Exactly.
See you in Miami. Facebook stock has dropped over 25% after reporting negative user growth for the first time. And not only $10 billion or maybe even $12 billion lost a year on their AR, VR headsets and project, but also a $10 billion decrease in projected 2022 revenue thanks to Apple's privacy features. I guess we got to go to you first, Chamath.
PayPal dropped 25% too.
Yeah, we got the pay. We'll and then Snapchat had a whipsaw back and forth. But Chamath, when you see this, you called this with your spread trade. Maybe you could walk us through what you saw, whatever it was 3, 4, 5 months ago, and then what you're seeing now. And at this level, with $250 billion wiped off the market cap, what do you think about the future of this as a trade and as a company?
Well, I think the trade did what it was supposed to do, which is in a period of a lot of volatility, I saw an opportunity to, just reduce my risk exposure. Look, I'm generally long very risky assets, right? I mean, all of us are in the business of building companies that have huge volatility because all of our companies generate earnings very far in the future. And so, in November of last year, I was trying to figure out what I could do to shield myself. And the reason I wanted to shield myself was because I saw Elon and Jeff in part selling, but also I saw that clearly we were going to go through a period where that high growth tech was going to trade down. So I sold some of that high growth tech, but then I also wanted to figure out a way where I could be less exposed to some of that volatility by continuing to hold what I had. And the best way that I figured out how to do that was to do the spread trade. And so, what I saw at the time was that there is one business above all others that I think is immune amongst big tech from any sort of real long-term issues, and that's Microsoft. And I think David expressed the reason well, is that it's an enterprise business now. Politicians generally don't tend to care about enterprise businesses. They have enormous longitudinal growth in front of them, and they're able to do things on the margins, specifically around M&A, to keep building their business with very little oversight. And we saw this because they had the courage to do this Activision deal, just a few weeks ago. If you could imagine, again, no other company in big tech could even dare try to do a $70 billion acquisition because of the scrutiny.
In this climate, it was a bold move, yes. Yeah.
I think it's not a bold move. I actually think it says the obvious, which is Microsoft is beyond the level of regulatory scrutiny that the rest of big tech actually has because they are consumer businesses. The second safest company is Google. And the reason is that Google has the best of both worlds. They're both a platform because of Android, but then where they are at risk of being an app, they have an incredible deal with Apple that blunts that effect. And so when Apple talks about all their push to privacy, you still have this very specific relationship, and Facebook called it out in their earnings release. They said, we believe that Google has preferential treatment relative to the rest of the internet in that Apple deal because they pay Apple $15 or $20 billion a year.
And for people who don't know, that's for search. The default search on your iPhone goes to Google. Google pays $15 billion to Apple. Right. And the accusation, explain the accusation there of why that would give them preferential, in case people don't connect the dots.
Well, if you're paying somebody $15 or $20 billion a year, they're less likely to do bad things to you. They may do bad things to other people, but they're not going to do as many bad things to you.
Did you believe that?
Yeah.
That allegation from Zuck, yeah.
Well, no, I don't believe the allegation, but I think that general that general thing is true. Like, you're not going to screw over your partners. You're going to screw over other people before you screw over your partners.
Got it.
Whether this applies here, it'll have to be borne out in some kind of lawsuit or state AGs or blah, blah, blah. But anyways, I think the point is that every other company has a lot more headwinds than Microsoft and Google in big tech. And then the third thing was a market observation from Gavin Baker, which I thought was incredibly brilliant. And what he said was, when you see a drawdown, meaning when the markets go down, it'll affect high growth tech first. It ended up touching a bunch of other areas second, like biotech. But he said this key thing, which is big tech will be the last to crack, but when they do, they are going to get shot. And so I spent a bunch of time just trying to figure out, when big tech gets cracked, who's going to get cracked the hardest? And I just kind of wanted to create a spread between those who were the most inoculated to those that were the most at risk. As it turned out, Netflix puked it up. Facebook puked it up. Amazon actually got really crushed, even though this past day they had a pretty decent rally because of their earnings, but they really got crushed. So in any event, the trade is what the trade is. The bigger thing is what is going on at Facebook. And I think what you see are three really important headwinds that Facebook called out explicitly. One is that when they talked about usage kind of flattening and starting to decay, what they're really talking about is TikTok. And I think what we learned is that TikTok is an enormous threat and a huge competitive force now in the consumer social app ecosystem. The second is that Facebook is fundamentally an app that sits inside of an ecosystem that is subject to the rules of the platform owner, and that's Apple and Google. And so this IDFA change, so the change in how you can track advertisers, Facebook said is going to have a $10 billion impact in 2022. And then the third thing, which was more implicit, is in order for them to grow, if you can't grow organically, the only other way to grow is inorganically. And unfortunately, as we're seeing, the regulatory focus on this company is really enormous. And so it was a pretty watershed moment in, I think, that company's discussion of their future. And Mark actually kind of said that as much in the press.
Sacks, you look at this business, you made a interesting observation. Facebook rebranding itself as Meta before Meta exists, it may be looked at as another sort of sign that maybe they got a little tilted, maybe? What was your take on the sort of changing the name of the company before that business really is at scale or exists?
Yeah, I mean, it's a bubble move because, look, when you're in an up market and the market is super frothy, we had, in hindsight, last year was a giant asset bubble funded by all this liquidity coming out of the Fed and the federal government. So yeah, in a bubble like that, all investors care about is the growth story. And so Facebook went all in on this story around Metaverse, but in the cold light of day, once the punch
sun came up.
Yeah, once the punch bowl's been taken away and you're in the hangover and you're in sort of a very volatile,
the DJ packed it in.
Yeah, bear market. Investors go, wait a second, this VR division is losing $10 billion a year.
It might even be 12, by the way, because they said it was a little higher. So
they lost $6 billion last year. They lost $10 billion this year. So the losses are escalating. And so in that kind of market, investors are like, wait a second, do I want to invest in a company that whose future is that unclear? I mean, if you look at this market, we've seen that the growth stocks are down 60. Today's an up day. Yesterday was a horrible day. So they're bouncing around 60, 70% down off the highs in early November. Okay. But the FANGs are only down like 14% or something like that.
Right.
But Facebook basically took themselves out of the sort of the market leader bucket and put themselves in the growth bucket.
They were like, treat us like Peloton. We're speculative.
Why would they want to do that?
It was a terrible strategic decision, you're saying.
Well, it was a decision. It was the kind of decision where you look back with 2020 hindsight and you say, look, that kind of decision could only be made in a bubbly, frothy market. You would never make that decision in the kind of down market you have today. And other decisions look stupid as well. So PayPal was just down 25%. Okay.
Why was it down? Yeah.
Well, they just,
no growth in users?
It was mostly on the forecast. And yeah, they revised their forecast down considerably. And of course, they tried to blame it on the economy, but other companies, Amazon just had a huge beat relative to expectations.
Yeah.
They're up 15% today. So not everybody is blaming the macroeconomic picture the way that PayPal did. Any event, my point is you go back 6 months ago and, what was PayPal doing? I wrote a story for Barry Weiss for her Substack about how PayPal was taking the lead in financial deplatforming. They were working with the ADL and the SPLC to identify groups to kick off their platform. So that's what management was spending their cycles on, figuring out how not to grow, how to kick people off their platform, and trying to figure out how to get more people on it.
Sounds familiar. Who else is trying to kick people off their platform?
It's the kind of thing you do when you're in a frothy market and your stock is up and you're feeling triumphant. You can waste your management cycles on stuff like that. Now that their stock is down 25%, you have to wonder, gee, do we wish we had spent our time on other